just want you to understand a little bit, because it's LVXO, we offer CFD trading. So remember, you're not buying 100 bars of gold to put in your safe deposit. And when you trade Apple shares or Facebook shares or Google shares, well, Google's whatever, Alphabet, you're not taking physical delivery. It's not like you're going to a stockbroker and saying, I want 100 shares of Google, and you have to send him a check in the mail or transfer the money to him. He'll have the stock certificates issued in your name, and you have an asset that you can put in your safe deposit box or take to the bank and borrow against it. But you've also dished out all that money. And because CFDs are short-term trades, you're not investing to put it in your retirement package. You're not buying to own it to sit back. You're buying or selling to trade. And the difference with trading is to make profit. Unfortunately, we have loss, but to make profit on short-term movements in the market. Because we don't really care that Apple's worth $750 a share. We only care that today we think Apple's going to go down from 750 to 740. We don't care if next week Apple's going to go to 800, 900, 1,000. That's in my retirement package. That's my investment package. I'm only taking advantage of that short-term movements between the current price and the potential price. Now, we need a lot of analysis to figure those out. And Fibonacci is one of the most well-known, well-used tools there are out there. Now, unfortunately, I come across a lot of traders who don't want to put the effort into learning the underlying mathematics and the underlying understanding of how an indicator works. Now, granted, maths are not a fun thing to do, although I'm an accountant by profession and I have my degree in math, and I like math. But most of us don't like sitting around and calculating ones and twos and fours and sevens and all the other kind of stuff. We just want to trade. Well, I could tell you exactly what to do when Fibonacci did this, but you'll never be able to pick out the nuances. You'll never be able to make an intelligent decision. Now, you never have to calculate anything, but you should understand where these retracements come from, how they're calculated, what the numbers mean, so that you can pick out the false signals from the good signals, or figure out how to use it in combination with your other trading systems. Now, Fibonacci retracements are ratios, but these ratios come from what's known as the Fibonacci sequence. Now, the most popular retracements are 61.8 and 38.2. Now, we have more of them. We have 23.6 and 78. There's tons of Fibonacci retracement levels. In finance or in trading, we look at three important levels, and that's the 38.2, and in between that's the 50% retracement, and the next comes the 61.8. But the 50% retracement has absolutely nothing to do with Fibonacci. It's from Dow theory. Dow theory states that when a market moves up or down, it will most likely retrace 50% of its prior move. But in online trading and our new advanced charts, 50% retracement has been stuck in there with the Fibonacci tool. So when we put it on our charts, we'll see 38.2, we'll see 50 and 61.8. Now the question is, where does all this come from? Okay, how do we get all the way down to the 61.8%, and what does it mean? How do I use it to my advantage? Now, tonight's class is not designed to delve into the deep mathematical properties. But we do need that cursory understanding. So the Fibonacci sequences, you could actually sit down with a paper and pencil and duplicate it yourself. It's not quite difficult. It's just monotonous. The Fibonacci sequence, not the Fibonacci ratio, starts out very easy. It starts out with a 0. You take that and you add 1 to that 0. What do you have now? You have 0. Start now. You have 1. You add those two numbers together, and what do you have? You have 1. Somebody told me once, and I'm not sure about this, it comes from adding rabbits and watching them multiply. So if you start out with no rabbits and you got 1, what do you have now? 0 plus 1, you have 1. You add 1 more into that, you have 1 plus 1, and what do you got? You have 2. So what are our first 4 Fibonacci numbers? 0, 1, 1, 2. Now, if you add 1 more into that, you end up with 3. And if we were to take that 2 rabbits and 3 rabbits and add them together, we'd end up with 5. And then we take the 3 rabbits we had, the 5 we have now, and we'd end up with 8. And then we take the 8 rabbits we have now plus the 5 we had, add them together, and we got 13. And then we end up with the 13 plus the 8 we had before, and we end up with 21. And the numbers never change. You don't have to memorize these. They go on till infinity. They go on forever and ever and ever. But this is where they come from. 0, 1, 1, 2, 3, 5, 8. And there is a very complex mathematical formula to get to them to see if somebody said to you, I have a number 8,472,000, whatever. Is that a Fibonacci number? The only way I know how to do it is to calculate, to do all those numbers out, be here forever doing it. But there is a calculation. But most of us couldn't do this calculation if we had to. But now we have these numbers that fit this Fibonacci sequence. Well, how do they help you in trading? How do they help you in anything? How do they help you in the world? So remember, we have 1 plus 2 equals 3, 2 plus 3 equals 5, 3 plus 5 equals 8, and so on and so on and so on. Now, the interesting thing is if we were to take this sequence of numbers and take the current number and divide it by the previous number. So let's use this segment right there. So if we were to take 21 and divide it by 13, it would give us 1.61 something. If we were to go the next step and take 34, which would have been the next number, from adding the 13 and 21 together, and divide that by the previous number, the 21, we get 1.61 something again. So on and so on and so on until eternity. So the approximation is 1.618. Well, 1.618 is what we call a Fibonacci extension. Because anything past 1, because 1 would take you back to where the price was before the previous move. Anything beyond that helps us project where price keeps moving, where it would move to after it recovered the 100%. Going the other direction, if we were to take, let me clear this off so it's not so confusing. If we were to stay with this sequence, and if we were to go in reverse, and we were to take the 21 here and divide it by the previous. So here we took the 21 and divided by 13. Here we're doing the reverse. We're taking the previous and dividing it by the current. It would give us 0.619. The next set would give us 0.617. Then would give us 0.618. So on and so on for eternity. So that is averaged out to be 0.618, which is one of the Fibonacci retracements. In Forex or trading is 61.8% retracement. If we were to go 2 digits over, that means here we would have taken the 13, added it to the 21, and what we would have gotten? We would have gotten 34. So now if we take the 13, skip the 21, and divide it by the 34, in other words, we're going 2 digits over, we would get 0.382. And no matter how far out into eternity, we would always get 3.382, which is 38.2. Now you can say this is lots of roundabouts, but we're rounding about all these digits over to the right. They're small, inconsequential numbers. Because we could have rounded this all out to be 1.61. But remember, trading isn't exact numbers either. Yes, what you're buying something for, what you're selling something for is, but when you're doing a support and resistance level, you're looking at volume, you're looking at a trend line. These are all part of art and not science. They are not finite numbers. That's a problem a lot of traders have. They want to set my support line is at $1.40 or $34,257, and they're waiting for Bitcoin to hit $34,257 to do exactly so. But Bitcoin might have reacted at $34,721 at 52 cents because it's a range or it's a zone, it's an alert. So right now, what do we have? We have 1.61 here. We have 61.8 from here. We have 38.2. I'm not very good at writing numbers. I wish they would let me I wish the system would allow me to type right on the screen, but it doesn't. So, and this gives us our Fibonacci sequence, our Fibonacci ratios. So what we've done is we've converted this sequence of numbers into ratios. And then we shove 50% in the middle. Now, it sounds like a bunch of hogwash. It sounds like I made this all up to make you interesting for you to in class. But the fact is, 1.618 is called the golden ratio or the golden mean. It's also called phi. This ratio has existed for hundreds and hundreds and hundreds of years. It didn't come through some kind of mathematical formula that somebody came up with to trade Forex. It it didn't get invented by some guy who's trying to give you some trading system. It is a mathematical basis for the shape of playing cards. The design of the Parthenon is sunflowers, or actually, if you look at the squirrels in a snail shell, Greek vases, and actually the spiral of the galaxy. Now, it's said that the beauty of a man or a woman is based on the ratios between their eyes, nose, and mouth. And the closer they fit the Fibonacci ratios, the more attractive our eye finds them. I don't know why, but we see Greek architecture and it's quite lovely. Now, when we take this and try to apply it to the financial markets, we call these Fibonacci retracement patterns. And this is because an asset will often pull back or retrace a percentage of the previous move before reversing. So in other words, when the market moves up, it will tend to ease back down either 38.2, 50% of that move, or 61.8% of that move. Now remember, and this is the last time I tell you, 50% is not a Fibonacci number, but it is a retracement number. Now, again, the 50% came from Charles Dow, who developed Dow theory, which is where the Dow Jones gets its name. Now, what do we mean by a retracement? Well, when an asset, when gold moved this morning from, and I'm just making up these numbers for gold, and I'm just using gold because it's easy to say. When gold was trading this morning, hypothetically, because I don't even know what gold opened at this morning, was trading at 1,700, and it moved up here to 1,750. Now, nothing is to say it's not going to move up here to 1,850, and 1,900. The market doesn't move like this. The market moves in push and ease, push and ease, push and ease, push and ease. When we get this ease, it will most likely relax. So we had gold move up from 17 to 1750. Okay, that's $50. If we were to say, let's make it 1800, it's easier for math. That's a $100 move. So if we were to say that gold starts to retrace, we would look for gold to retrace down 38.2% of that, or down to 1762.8. Okay. Now, that doesn't mean gold's got to stop there either, but that is one strategical point that we would be watching. If gold doesn't stop there, we could expect gold to drop down to 1750. And if gold continues down, because we're not saying the price is reversed yet. We're not saying the uptrend is over. We're not saying the rally is over. We're just saying it's taking a breather. So it might even retrace all the way down here to 61.8, which would mean at 1738.2, gold would rebound. So these would be important numbers on our chart to watch as price moved. Now, this is for short-term trading, because we also, if we go back and look at, say, XXX stock and look at it over the last year, maybe it went from $50 a share all the way up to $200 a share. Well, at some point, it's going to ease back down. Now, what level will we expect it to ease back? So this is, now there were up and down moves in here, but this was the long-term trend for the year. So we would be basing this on a yearly view, not on a short-term view. This is our short-term view for what gold just did the last few hours. So you can have fibs based on 1 hour charts. You can use your Fibonacci on 1 day charts. You can use your Fibonacci on 1 month charts. And you can pick the trend you wish to use to develop. Using a 1 month or chart won't help you in short-term trading, but it would help you see what environmentally would be important. So what we need to do is put our Fibonacci on our chart and see where these levels are. You can think of them as new additional dynamic support and resistance zones. So after a stock makes a move to the upside, it can then retrace a part of that move before moving again in the desired direction. These retracements or pullbacks are what you, as a swing trader, want to watch for when initiating long or short positions. Once a stock begins to pull back or retrace, then you can plot these retracement levels on a chart to look for signs for a reversal or a continuation. You do not automatically buy a stock just because it's at a common retracement level. Wait for a candle pattern to develop at the 38.2 level. So in order to find these Fibonacci retracement levels, these significant levels, you have to find the recent swing high and swing low. Fibonacci can only be used with a previous trend that has ended, because there is no swing low in a current trend. What it's going to do is project forward to give you these retracement levels in the current move. So let's go over and look at a live chart. Hold on a sec. So this is the current Euro-US dollar 1 hour chart. Now, the most important about Fibonacci, and what will make you a better analyst and a better user, is this is the live chart. We can see that the Euro-US dollar, and the only reason this is picked is this is my standard teaching chart, but we can see the Euro-US dollar is now in an uptrending move. We can see we had a downtrend that has ended. Now, the important thing is, and what I said to you before we looked at the chart, is the significant swing high and swing low. Too many people Too many traders want to live by sheer rules. A swing high and a swing low technically would be the highest point and the lowest point achieved during that prior move. But Fibonacci is based on the significant swing high and swing low. But you know, all kinds of things make a stock or a Forex or a crypto bounce up for a second and come back down. We could have a very, very long high and a candle, a very long wick and a candle that stayed for 1 second, but it's still calculated. So what we have to be able to do is find the significant point in the high and the low where price reversed. So here I've isolated the significant swing high. This is the point in which this downtrend started. Now, even though it moved sideways, it actually started to move down before it then jumped and moved down. This is what I would call the significant swing high. Now remember, we're looking at a trend that has ended. Too many people would like to put it here. A lot of people might say it's here. This is the difference between you, me, and the guy next to you. Some people could say it was here. I say this is where that downtrend originated. This is when we got the candlesticks. And this is the highest point that market told us it was going to go down. It was going to reverse. Now, granted, it moved sideways for a short while, but then this is the significant swing low. It's the lowest point it made. And we can see from that point forward, it didn't move any lower. We did have a low below that, but this was where the trend reversed itself. Because remember, we're drawing the Fibonacci based on the old ended trend. So now we're going to go to our Fibonacci tool. Hold on, let me move my marker off here. And we're going to go to our Fibonacci tool. And there's lots of Fibonacci stuff. We want to look for our retracement. Now, when we've come off of a downtrend, we want to put our mouse. Why is this doing backwards? Hold on. Oh, sorry about that, guys. We want to pull from our downtrend, from our slow up to our high. Okay. And as you can see, it's now put these levels on our chart moving forward. Hold on. For some reason, let's try this over. So we're going to go to, no. It keeps just dropping these on my chart. Let's get rid of it. Let's get rid of it. Okay, now they're all gone. So we can go here. So now we've got our significant swing low. In a downtrend, we pull from the swing high to the swing low. In an uptrend, we would pull from the swing low to the swing high. So we can see that now, and you can set your Fibonacci's to do whatever you want. Okay, let's make them a little bit broader so it's easier for you to see. So you can see these lines, and they've been pulled forward from where I started them, and they get extended into the future. Okay, this is, let me get my marker on here. This is the 1 or the 100%. This meant this would have retraced if it reached up here to 100% of the previous move. This is the 0 line because that's where it started. So right now we've moved up, and we are now approaching the blue line here, which is a 23.6 retracement level. Okay. And we can see that we had a nice little reaction to the 23.6. We continued moving up, and price is now moving to the 50% retracement level. This move is equal to 50% of this move. So we're expecting price to come up to the 50% retracement level. Now, doesn't mean the price can't continue going up. We would expect some type of momentary, at least momentary, reaction there. Okay. Because price, like I said, doesn't move this way. Price moves this way, this way, this way, this way. So we would expect something to happen at the 50% level. It's not saying it can't go right through. It's not saying it won't hesitate and then go through. It's not saying it won't hesitate and fall back down. But you know what? If you know where you're expecting some type of reaction, you don't know what the reaction is going to be, but you know when to expect that reaction or where to expect that reaction, you can be prepared. And most likely, if it bounces off of the 50%, it could come down to the 38.2 level and then bounce back up to the 50% level. So 38.2 is the green line right here. I'm sorry, I have all my support and resistance lines on there. Once I take them off, they go away forever. So, and we would expect if it broke to 50 to come up to 61.8. Now it might hit 61.8 and fall back down to 50, move back up to 61.8, and might go up to 76, 78.6. Okay, this is about the steepest point of retracement before we're going to actually start calling it a reversal. At this point, we're expecting the uptrend to continue. If it reverses off of here and falls down, back down to this level, we're expecting it to end. Okay, so the first crux of Fibonacci is placing your retracement tool on your chart. So let's go back to my PowerPoint. So for downtrends, we want to click on the swing high and drag the cursor to the most recent swing low. For uptrends, we want to do the opposite. So swing low, pulled up the swing high. Swing high, pulled down the swing low. So in order to apply Fibonacci levels to your chart, you'll need to identify the swing high and swing low points. Now remember, these are alert zones. They're not finite numbers in a line drawn in the sand. So keep in mind that these retracement levels are not hard reversal points. Instead, they serve as alert zones for potential reversals. Now, there's some interesting ways that we can start using these retracements. One is, say you're using an hour and a half-hour chart, is to take the Fibonacci from your half-hour chart and your 1 hour chart, and then they will give you different numbers, and you can look and see where those are and build actual zones with them. Or you can look at prior Fibonacci retracements that were on your chart in the past, because they will continue on forward until you take them off of your chart. So like you see here, these fibs were drawn on this chart way back when and projected into the future, but we've continued to use them moving into the future as prices stayed within that ultimate downtrend. But here is an interesting way of using two different sets of fibs from different time frames for the same asset and overlapping them over each other. It's almost like using a 50 period and a 65 or a 70 period moving average and seeing the difference in how they relate to one another. Now, Fibonacci's can also help us find entry and exit points and where to put our stop losses, because if we use the Fibonacci retracement tool and we saw Fibonacci move, the price move up to the 50% level and bounce off of that, what would we do? We would set our stop loss at the 38.2 level. Okay. And if it falls below the 38.2 and keeps on going, we'd want to close out our trade. If it bounces off of that and moves back up, we'd be all right. And we could use the 78.6 to set our target point for our risk management to enter a trade. And we could use the 50% level as an entry point and say, okay, it's broken 38.2, it's moved up here, and when it hits the 50% level, I'm gonna execute my trade. I'll take my stop loss at 38.2 and my take profit is 78.6. Now you can't. That's a really basic explanation because you have to look at many other things. You have to look at it, whether there's significant support and resistance area in that area, whether there's been a breakout from a chart pattern. You just can't just blindly use this. But using the Fibonacci stop loss approach is especially interesting because it offers a more objective way to place stops. Whereas the trader has to make decisions subjectively as to when to move the stop based on the moving average or swing strategy, Fibonacci levels don't have this component. So once a trader has drawn his Fibonacci levels, they don't move anymore. And the potential stop loss levels are well defined. In the example over here to the right, the trader drew the Fibonacci tool during the downtrend and then used the retracement levels on the right to trail his stop loss. The trade exit happened once price failed to move to the next retracement level. So the first method is to set your stop just past the next fib level. If you're planning to enter at 38.2, then you would place your stop beyond the 50. If you felt the 50 level would hold, then you place your stop at the 61.8 level. Now, if you want to mitigate your risk, another way to set your stop loss would be to place them past the recent swing high and the swing low. The truth is, just like combining the Fibonacci retracement tool with support and resistance, trend lines, and candlesticks to find a better entry, it would be better to use your knowledge of these tools to analyze the current environment to help you pick a good stop loss point. As much as possible, you shouldn't rely solely on fib levels as support and resistance levels. Remember, stop loss placement isn't a sure thing. So the first thing you should know about the fib tool is that it works better when the Forex market is trending. The fib tools do not work well at all in a congested or sideways moving market. So the idea is to go long on a retracement at the Fibonacci support levels when the market is trending up, and to sell on a retracement at the Fibonacci resistance levels when the market is trending down. When you are placing an exit order, it's a good idea to place it just before the level you plan to exit at. You should practice it yourself, and it may be a better place to exit a few points earlier than at the exit level. So when you are placing an exit order, it's a good idea to place it just before the level you plan to exit. Now, the 78.6 level is an important level. It's one that's overlooked because it's a very steep level. So imagine yourself in a store and a salesperson all of a sudden says, all of our goods are available at 78% off. Guess what? Buyers step in at least some. The same principle, whether you needed something, don't need something. You hear the 78% off and you're going to jump in, you're going to go run around the store and buy up all the stuff you didn't need, don't want, don't have, just because it's a cheap price. That's what happens in the market. It's a simple market psychology. So 78.6 retracement is like the last opportunity to join a trend at a discount and hopefully ride the continuation. Now, of course, you have to do the proper analysis, but it might give you a way to get in at a very low price when you're expecting the markets to rebound. So Fibonacci retracements are often used to identify the end of a correction or a counter trend bounce. Corrections and counter trend bounces often retrace a portion of the prior move. While 23.6 retracements do occur, the 38.2, 50, 61.8 cover the more possibilities. This zone may seem big, but it's just a reversal alert zone. Other technical signals are needed to confirm reversals. Reversals can be confirmed with candlesticks, momentum indicators, volume, or chart patterns. In fact, the more confirming factors, the more robust the signal. So thank you very much for joining us this evening. I hope you learned a little bit about Fibonacci. And if you have any questions, go to www.alvexo, click on the live chat button, and somebody will be glad to help you. They'll even hook you up with a financial analyst who can talk to you directly and answer all your questions or go over to their education. They have lots of material for you. Thank you very much and have a great trading week. Bye now.